Hello, and welcome back to the Wallfacer podcast. Today's guest is Andrew Keys, co-founder and chairman of the Ether Machine. Andrew is also the managing partner of DARMA Capital, and previously, Andrew was the head of global business development at Consensus from 2015 to 2019. Andrew, welcome to the show.
Thanks for having me, Ryan.
Yeah, my great pleasure. So maybe for the listeners who have never come across you before, I would love to learn about your background. How did you get into Ethereum, crypto, and really importantly, what gave you the conviction to join Consensus so early?
Sure. So quickly, I had a background understanding, and I was educated in economics and computer science, and worked on Wall Street and built a few different software businesses. And I came across Bitcoin, and I thought it was an interesting concept, but frankly, there was one asset, a Bitcoin, and one function to send. And having been privy to Earth, I knew that Earth is a bit more sophisticated than having one asset and one function. And I didn't really jump into the blockchain space until I saw the ability to have arbitrarily complex logic embedded into assets, which are basically smart contracts. And I read the Ethereum white paper and went like a complete nerd to the first ever Ethereum meetup in Manhattan and met Joseph Lubin, the founder of Consensus, and a handful of other brilliant technologists and business builders that were there and are still part of the Ethereum ecosystem today. We got to work. And basically, we started out to build kind of crypto alphabet, if you will. You know, like Google is one of many companies that Alphabet Inc. owns. And basically, we've quickly realized before building the application layer, we needed to build the protocol layer, the developer tools, and then the wallets as an example. And so basically we built 3 of the 8 implementations of Ethereum, all the way through the developer tools like Truffle, which was an IDE, an interactive developer environment, through Infura, which was like a load balancer for building the applications, MetaMask, and ongoing. I worked within Consensus for quite some time, sat on the board of directors of CSI, Consensus Software Inc., and also created a commodity pool operator and commodity trading advisor when Ethereum was transitioning from proof of work to proof of stake, because I believed Ether would be deemed a commodity, and the commodity pool operator and trading advisor was registered with the CFTC, which governs commodities. And we began staking bare metal institutional size from inception of Ethereum's proof of stake. So we were there day zero stakers. And basically that brings us to about 6 months ago when I was approached by one of the large ETFs that were considering how to deal with the withdrawal queue of Ethereum. And it's very timely to have this discussion right now because there was a staking provider that has exited all of their validators, and the withdrawal queue bumped from a couple days to, well over a month. And basically ETFs have a 24-hour withdrawal window that they're mandated that if you want to redeem, they have to give you your dollars back in 24 hours. And basically that doesn't jive very well with this deterministic, arbitrarily, vague number of days that if, God forbid, a black swan event, I would call this like a pink swan. One validating company has moved their withdrawals, and now we've got 40 days to wait. But if, God forbid, a black swan were to happen, it could go to 6 months or a year. And so I quickly realized that it didn't make sense for public market investors to deploy their capital into the ETFs. Because if you look at the ones in Canada or Europe, which do enable staking, they only stake at what I call 50% capacity. So if you have $1 billion in the ETF, it's only staking 50% or $500 million. And so when it's only earning the floor yield, which is what I would just call vanilla staking, and that's about 3% today. So on the $1 billion, you're really only earning 1.5% because you're only staking 50% of it. And so, I thought, we could actually have an operating company that stakes 100%, and we could also have the other 2 buckets of yield generation, which is restaking and DeFi. And that kind of brought us down the path to the Ether Machine. But I spoke a lot, so I'll pause there.
Hi, this is Ryan, host of the Wallfacer podcast. I want to tell you about our latest product that we think will change how you interact with DeFi. Managing DeFi positions across protocols is complicated. That's why we built Vaults.fyi, a single, clean interface for accessing top protocols like Aave, Compound, Morpho, Euler, Lido, and many more across major networks. No wrappers, no extra contracts, just direct access to the best yields with real-time analytics. If you've gotten any value from this podcast, please try it out at vaults.fyi. The link's in the podcast description, and my DMs are open on X and Farcaster. I read every piece of feedback. Now, back to the show.
No, that's great. I mean, you've taken the conversation already so many different directions I can go from there. I'd love to go back to the early days of consensus at some point,
Sure.
but maybe first, I mean, just thinking about it. So I think you've approached the big question I want to get to in this interview, which is what is the relationship, or what is the investor base who thinks, hey, I would rather have exposure to Ethereum through a DAT versus I would rather have exposure through an ETF. And
Sure.
I guess my summary for the Ethereum DATs today is that the story, at least, is, hey, we're going to do alpha generation beyond just holding ETH in this ETF-like vehicle. Would you also sum it up as that's the big value prop today for investors who are thinking through this? Or
So that's one of two, right?
Okay.
So like when I think about this, like I think of, let's talk like differentiation, right? Because that's what you guys really want to get to. I think it's pretty easy to differentiate Bitcoin versus Ether. Bitcoin's one asset, one function. Ether, we can generate any asset and have infinite functions, and it generates yield. So then the next differentiation is the ETFs versus let's just call it the digital asset treasuries. You're correct that let's just give the ETFs the credit that eventually they will enable staking. They're only going to be able to stake at a sub capacity, let's call it 50%, which if you look at Europe and Canada, that's where they're staking at in capacity now. So we're able to do 100% of vanilla staking, plus we have discretion to be able to participate in DeFi, participate in restaking. Now that's the, let's call it on-chain side of the equation. The off-chain side of the equation is really what MicroStrategy pioneered. And what I mean by that is, as a public company, we're able to issue equity and credit instruments to essentially generate more Ether concentration per share. And what I mean by that is that, for example, we could issue a bond where we would take in dollars and we would be able to service that coupon with, let's call it the yield that we're already generating. And then we're able to buy more Ether with those dollars that we've taken in and increase our Ether concentration per share count for our investors that are looking to grow their Ether, not just track an ETF. So there's the on-chain, and then there's the traditional capital markets part of the equation as well. So there's really kind of two arrows in the quiver.
Yeah, and on that off-chain and sort of the metrics traditional investors are thinking about, I've seen a lot of debate around this. I mean, what is the North Star metric for you that you're going out there and telling the story around?
It's 100% Ether concentration per share. And it should be the monthly update of the Ether concentration per share, because we could say that, like, right in the beginning of Treasury mania there was a pop, but now it's going forward month to month to month, how much new additional Ether is generated per share. So kind of that growth metric.
Got it. I see. Makes a lot of sense. And I guess as you're thinking about DeFi and some of the other strategies that you want to employ outside of the Ether machine, where are you seeing sort of traditional investor appetite there? Are they excited about having someone else who's kind of doing this active management for them? Is there still a lot of education that goes into that? How are those conversations?
There's a ton of education. And I would say the investor appetite really is just understanding still, what is Ether? What is Ethereum? What is staking? Like, we're not even going down the rabbit holes of what is Aave, what is restaking. And so basically we're just kind of explaining use cases like stablecoins and what is the TAM of a decentralized internet, and kind of wrapping their minds to get it, because a lot of it at the institutional level, which is our primary client base, there's been a lot of kind of crossing the chasm of what is Bitcoin. And then kind of this is kind of a 2.0 conversation.
And how are those conversations?
They're going well. I mean, we raised the largest common equity round in since 2021 in July, and then just did another follow-on round. So we're cooking. And I think that this is one of the privileges and responsibilities that we have as a public vehicle in the Ethereum ecosystem, to be stewards of the message and to explain to planet Earth what this is.
Yeah, and that was almost my next big question, which is, as you're going out and telling the story, even the narrative within the industry, within people in the know for what is Ethereum has evolved so much over time. There's the Infinite Garden. It was the world computer. It's a smart contract platform. Now
Well, that's like the internet, right? I mean, like to that point, the internet, 25 years ago was a place where you could buy books on Amazon, and here we are, right? And it's hard to grasp what this machine is capable of doing.
How much of the narrative that you're going out there and getting people excited about is the more stablecoin and RWA narrative? Is it more of the traditional immutable DeFi?
So what I'd say is what's resonated, right? Data is stablecoins, right? I think that this is the first true product market fit of blockchains, and as evidenced back to the data with the Circle IPO, we're in kind of the best position possible to explain the notion of Ethereum as a vehicle that gives you a price discovery mechanism for the value of intermediation. And in the stablecoin example, we have a price discovery mechanism for the value of the intermediation of a payment processor. And the example that I give there is when you go to buy a shirt online, there's pay with Google, pay with Amex, pay with Apple Pay. And now there's a button that says pay with stablecoin. And what I've seen, and this is real life happening now, not theoretical, is if I pay with Google, Amex, or Apple Pay, it costs $103. And if I pay with the stablecoin, it costs $100. And basically the delta there, the $3 delta, is the 3% payment processing charge that happens. And I think that explaining in that kind of simplicity, where basically you have this open source rail to send value, and basically that gave the price discovery mechanism, the price discovery of what the payment processors are worth.
Yeah, that actually does. I mean, everyone that you're talking to, I'm sure, is familiar with the business of a Visa and these companies. So that does give you some sort of a framework to establish some TAM there. I'm curious how, for these investors, right, they're going to see and be aware of, Stripe is launching a layer one now, and Circle is launching the network. And I think it is indisputable that every company that deals in payments sees the stablecoin opportunity today. I guess how, one, do you personally envision Ethereum's role going forward in payments and stablecoins? And then also, where is that message resonating, or where are you hitting some of these roadblocks?
Good question. So when I think about Ethereum, I think about there's a technical definition, which is high quality liquid assets, HQLA. And if we look at blockchains, there was a great report created by Consensus, and on that report there is a graph of high quality liquid assets per blockchain. And basically right now there's $250 billion of high quality liquid assets on blockchains. So stable coins, real world assets, tokenized stock, etc. And 90% of the high quality liquid assets are sitting on Ethereum. And settling to Ethereum. The greatest blockchain is Solana with about 9, and then it's 0.7%, 0.5%. And so the greatest beneficiary of the Genius Act that just passed was Ethereum, because the majority of these assets are sitting and settling onto Ethereum. And so I do think that Ethereum's in a hegemonic position, again, by the data, of being the settlement layer for these high quality liquid assets. And that reminds me of Google with respect to search, where 90% of searches happen on Google, and Yahoo gets 1%, and Ask Jeeves gets 1%. When's the last time you used Bing? And I think that we've seen a world Previously we saw Facebook's attempt with Libra. And we've seen this kind of story previously, and history doesn't necessarily repeat itself, but it kind of rhymes, where these companies try to create their own walled garden, and in a sense, that's what we already have now, and we'll see how it works. I actually think that if I were Circle and I was trying to generate revenue, I wouldn't generate new revenue by like creating a new blockchain where I have to now maintain it versus something that's dirt cheap and works really well and has all the liquidity like Ethereum. Like I would go back and renegotiate my contracts. They pay 50% of their revenue to Coinbase. And I just think that they're kind of in a tough spot now that they're a public company when they're going to have these quarterly metrics that they've got to meet. And I think it'll be an interesting evolution, but we'll see.
I agree that, it does feel like, at least looking from the outside, Circle seems to be in a tough spot. And, at least from a strategy perspective, has a lot of interesting people coming for them at every angle, but different topic. Coming back to Libra for a second, because I remember, when that announcement came out, I was working on a stablecoin myself at the time. And, it feels like right now, stablecoins are so primed for success because of the changing regulatory environment in the US. I guess looking back at Libra, say Libra had been launched in this regulatory environment where Facebook itself is less of a sensitive topic. What do you think, could Libra have worked in this environment, or were there still structural issues?
I think we have a much more constructive administration right now. And I can't, play the what if game because we'll never know. But I would say odds of success are probably 5x higher in this administration, and it might have been too early for its own good. But Meta's got all the money in the world, and they can spin one up again. It's not over till it's over.
Very true. Very true. Okay, so coming back a bit. So I would love to, I'd like to come back to Ether Machine, of course, but maybe first coming back to your first fund or company, which is DARMA Capital. So
Yep.
I think you mentioned that a bit when we were talking about consensus. Am I correct that
Yeah.
that was the kind of Ethereum commodity pool operator that you spun up? Can you? Yeah.
So basically, we've managed institutional scale Ether positions. Let's call it north of 10,000 validators. So that's north of 300,000 Ether. So large pools of Ether capital, 32 Ether per validator, since inception of proof of stake, with zero slashing events, generating yield in the top decile. Highest performance possible, is safest, and we are uniquely positioned in this to basically generate yield safely for a large pool of capital. We've got over $2.5 billion of committed capital as of today, and we'll be announcing and growing rapidly as we go through our S4 registration process at the Ether Machine. I think another important concept is that Andreessen Horowitz, as kind of a litmus test, invested in Eigenlayer, which is the large Ethereum restaking protocol, about a year ago. They invested $10 million at a $100 million valuation. I personally invested about 2 years before that, $2 million of my own capital at $25 million valuation. And basically, our firm has been at the forefront with Eigenlayer in developing this concept of restaking, where we use Ethereum's proof of stake security, over $100 billion of security, to secure other products, services, middlewares, technologies. I think data availability for layer twos is an important example. I think we're going to be securing language learning models, inferences. I think we'll be securing zero knowledge proof validation, which I think will be kind of the linchpins to this next generation of the internet, where you talk about AI and agentic models and the privacy and confidentiality of this technology, and kind of the layer 2 scaling solutions that Ethereum is working on.
Yeah, it's great to learn some more about the activity you guys do at Dharma. There's not a ton about you guys online, so actually, I was curious. I mean, so outside of the Ethereum staking, also active in investing. You mentioned you work with Eigenlayer there. Is that sort of the other primary activity of the firm?
So at Dharma, we've had this institutional staking, and we have a Filecoin product where we actually lend Filecoin to staking facilities that use Filecoin to store files. But basically, we've taken kind of the best of DARMA and brought it to the Ether machine. Ether machine is essentially the evolution of DARMA, because we're going to have all of the know-how and the products that we have within DARMA, but basically we're transitioning that to the Ether machine that will have all of the DeFi staking, restaking, participation in DeFi primitives, plus the public vehicle on the NASDAQ that can issue various types of financial instruments to acquire Ether concentration per share. So basically, the Ether machine is a better mousetrap than DARMA.
Yeah, honestly, you nailed my next question, which is why even do that evolution in the first place? I saw that the firm has committed, over $600 million into the Ether machine. In some respect, I'm sure life was easier as a private company, private individual, but talk more about what got you excited about the public aspect.
So basically, I mean, I think there's like the philosophical part and the life opportunity part. There are a few times in your life where you get to be part of a movement that you really believe in, and it's a positive force for society. I truly do believe that this technology should give more value to the producers and consumers of goods and services and should thin out the middle layer, whether that's the bank or whether that's Uber or whether, whoever's sitting as the intermediary, the payment processor. If you look at the S&P 500, they've turned into these large oligopolies that are worth trillions of dollars. And I'd rather, the driver get the extra $50 than the Uber. And so I think that this is something that I believe in, and I just think that if more value goes to the producers and consumers of goods and services than to the intermediary layer, that's good for society. And then I would say, like, the self-interested rational actor believes that this technology should be sitting in a public market vehicle because the American capital markets are the best place to create financial instruments like convertible bonds or preferred shares, where we can issue these instruments to acquire more Ether, and then we can employ our skills, which is really the on-chain decentralized financial part of the stack, and teach all of the sell-side research analysts on Wall Street and all of the people on Main Street how to, what staking is, what restaking is, what DeFi is. And frankly, I think a lot of people probably don't want to do that stuff and don't have the subject matter expertise that we do to do it. And so we kind of package it and productize it. And that's fun to me.
How much of what you guys have been able to do so far, is something you've been actually meditating on doing for a while and has only been possible with the change in the recent regulatory environment?
Yeah. So I would say, I mean, it's what we are doing, right? I mean, like, all of the on-chain stuff we've been doing at DARMA since inception of proof of stake. So we've been doing it since day zero. And now basically we're going to do the same thing that we've done very well with minimal risk, and we're going to add a layer of access to the public equity markets and the ability to have, let's call it, the traditional financial instruments to be able to acquire more Ether, because I consider this to be, probably the most valuable commodity there will be in a decade.
Yeah, without a question. And I guess kind of, coming back around to the future of DATs, you guys kind of launched in an environment in which a lot of people launched Ethereum DATs and Solana DATs and, all of these non-BTC DATs essentially. And I think it's very clear right now, yield is going to be a part of everyone's strategy. How should we think about the evolution of DAT activities? Will you start acquiring crypto companies and have more of an operating business? What will they look like in the future?
Sure. So first thing that I'd like to differentiate for you, because I think that something that we did differently, is there's basically two ways to enter this public market. Because IPO takes, let's call it, a year plus, and coming from kind of, let's call it, a place where one has a basket of assets, it doesn't necessarily make sense to go the IPO route. So the two ways are, you can do what's called a shell reverse takeover. And basically what a shell is it's like when one is a shell of oneself, they're like a lesser version of oneself. And basically these are dying companies that have failed at whatever they were doing. And basically you're acquiring that company and then running that company going forward. And just to give you an idea, I had 3 conversations with 3 of these dying microcaps on the NASDAQ. One was a biotech where the drug didn't make it through clinical trials. And now the company was basically going to go bankrupt. And because of how the SEC works, there are what are called change of control provisions. And you can't just basically take a company over and say, kick the CEO off and say, I'm the new CEO now. And basically this CEO wanted $5 million a year to stay on the board, but he couldn't spell Ethereum. He literally wrote Ethereum, and that was kind of my aha moment there. Another one was a Bitcoin mining company that was in year 4 of a 10-year data center lease. We didn't need it because we have proof of stake. It costs $10 million a year. And he wanted me to pay year 5, year 6, year 7, year 8. So he wanted me to pay $60 million of his liabilities to basically take over that business. I didn't want that liability. Whether it was the CEO's employment agreement where you have to basically deal with this other operating business. And then there are other ones where you basically have a 4-year statute of limitations. And basically these companies have $0 in it. But now if they put $1 billion in it, they could be sued for something that they have done 4 years, nothing to do with your strategy going forward, but you're basically inheriting these debts. And so basically a lot have gone the route of just acquiring a shell company. And basically the version we did was we merged a brand new de novo, what's called LLC. And we anchored that with Ether. And then we merged that with a special purpose acquisition company. And basically, this is the cleanest route and the cleanest vehicle possible to achieve that goal. So basically, there are 2 ways to do this, and we went this route on purpose to kind of have the cleanest vehicle there was. And to your point, I think that you're going to see these treasury vehicles have, let's call it 99% of a core asset, and then they're going to basically potentially have some type of supporting assets that could be kind of considered ecosystem growth, or basically some type of accretive A, where you could buy something like a staking company in Ethereum's example that generates Ether, and that could be accretive accordingly.
And what do you think of that kind of strategy and approach?
I think that's directionally fine. I think what we've found, like I have seen like baskets where, somebody has 20% of Bitcoin and 20% of Ether and 20% of Ripple. And I don't think those are going to work well, because what I see is people want exposure to a specific asset. They want their Ether one. They may want their Bitcoin one. And people are sophisticated enough to know that. They don't necessarily want somebody saying, well, if they take issue with, there's 5 assets and they take issue with the 4th asset, that's, people are going to shy away from it because it's just like drag.
Makes sense. And what do you think of the trend in which we have more altcoin DATs as well, right? Are we going to see an Aave one and an Euler one? And we just saw World the other day.
We'll see. I think that some of these don't necessarily make sense. And I definitely don't think the ones where, some venture capital fund is unloading their bags and basically saying, this is locked up for 3 years and we're going to sell it to retail at 1-to-1, and they get the dollars, and retail has to sit through this liquidity, when in any other transaction, if I were to sell you something that's going to be locked up, you'd typically take a haircut on that and say, I'll buy it for 50 cents on the dollar or 70 cents on the dollar. And I think that, there's this concept of, if you play silly games, you win silly prizes. And I think things like, I think there's a lot of skeletons in these closets of these shell companies that are previously dying businesses. And that's something I'd worry about. I think that there's a lot to be said for, number 200 on CoinMarketCap trying to create its own DAT. And I think that there's going to be issues with that kind of after you get out the gate. Where's going to be your next source of liquidity to grow your asset base? Some of these just are illiquid tokens that don't have enough bid-ask spread. Ether has a $50 billion trading volume yesterday. I think kind of outside of Ether and Bitcoin, maybe Solana, it gets pretty tough.
Yeah, hard to disagree with that. Well, as we're coming up on time, I think it was kind of interesting to reflect. A decade ago at Consensus, you were working on things like the Enterprise Ethereum Alliance and trying to figure some of that out. And now you're sort of on this very large scale advocating Ethereum with this public vehicle. So I'm curious, looking back a decade and almost looking forward a decade, right? Looking back a decade, what would you have said to that, younger version of yourself? And looking forward a decade, where do you
Said so. I think I was a bit naive 10 years ago. And I thought literally, well, this technology just makes all the sense in the world. Like banks shouldn't exist and Uber shouldn't, should be a smart contract. And basically we're going to decentralize everything. And what I'd say is now I've learned you've got to, those incumbents have power and they don't want to cede their power to anybody. And you've got to build a better mousetrap and it can't be theoretical. It's got to have the same type of user experience plus, 10th of the cost. And that's going to be your kind of 10x moment. And I think the technology is just getting there where the usability with layer 2 scaling solutions is there. And we're not just kind of playing with wallets and shooting tokens to each other. So what I'd say is innovation takes time. You have to meet people where they are. And I think that this is an example of using a vehicle, a public markets vehicle, to meet investors where they are and to kind of cross the chasm with them. And this is like one pillar of many pillars of the Ethereum ecosystem, right? So there's still going to be lots of applications and developer tools and products and layer 2 technologies and privacy technologies that are all going to keep coming out in the decentralized world. And this is one pillar of those. And I think creating this new pillar is important to the Ethereum ecosystem because it does educate society from a kind of a macro scale of the power of the technology.
Awesome. All right. Perfect note to end on. Andrew, thank you for the time today.
Thank you.
Yep. And I look forward to speaking in the future.
Absolutely.
All right. Bye.
Cheers. Bye-bye.